As this started, we were talking about fundamentals. And there's a fundamental that goes on with the market on many levels that we're dealing with at the bank. And we're about to talk about markets and the economy, all of that fun stuff. But at the end of the day, all those little blips on the screen are people exchanging securities for some reason. Maybe someone needs to raise money to buy a home or send some child to college, or maybe someone is trying to save for their retirement. That's what's really going on every time we look at these blips on the screen. So it's a human business. It's not just about numbers, and we're very cognizant of that as well. So I thought that was a fantastic way to start this off, talking about fundamentals. A lot's happened over the past year, a lot of unexpected things. 2023 was not what anyone, including myself, thought was going to happen. We weren't expecting there to be a second consecutive year where the S&P 500 was up more than 20%, and yet we have it. That's happened, I believe, twice, including last year, in the past, say, 40. So it's pretty rare as far as animals go. We have changes going on globally. We're going to talk about a lot of this stuff politically here in this country, but just worldwide, actually. And, somehow, I wish there was something for me to knock on when I say this, but it appears that for now, we may have dodged that recession when the Federal Reserve was, hiking their rates before, and thanks for that knock over there, I saw that. Artificial intelligence. So last year, when I was standing up here, I mentioned the themes that were going to happen in 2023 that were really, really big. This was one of them. Didn't know how big. I mean, look at the news today. The whole market yesterday was in a swoon over something that happened over in Asia, which is probably less of a main event than is being made out by the media to be. However, AI is everywhere now. It's involved not just as something to strive for companies, but it's looked at as table stakes in many businesses, and this happened over the course of a year. It's only become more intense over the course of the past year, and it's likely to continue to drive innovation and to drive efficiency gains across every business. So we're watching this really keenly. This is something to pay attention to. Other big issues. Oh, we'll get to inflation, I heard that. How about return to office? This one's everyone's favorite right now. All of the bosses are out there saying, hey, it's time to get back at your desk. And we saw a swoon in 2023, actually for the past few years, really since COVID, where everyone was working remotely and there was this whole mentality that was the thing to do and you needed to, in order to remain competitive, offer that option for your employees. Now they're saying, hey, it's time to buckle down and get back to the office. And so this is going to drive trends in corporate office buildings in major metropolitan centers that have been depressed over the past few years, and hopefully, reverse a decline in real estate asset prices in those markets. We may see that, we may not right away, but this is a big change. It appears. An analogy is that, if you look at economy and markets and history as a pendulum, it swings back and forth and it tends to overshoot in each direction. And we're seeing a big swing, a reversal of that pendulum at the moment in that. Okay, almost fell for it that time. How about the new cuts that are on their way in government spending? This is a big one. Yeah, that. For those that aren't aware, that's the Doge dog for the Doge department that's out there for, what was it, Department of Government Expenditure or something like that, where efficiency, yeah, thank you, where they're going to cut many programs, some of which we've already seen news of as of today, and it's only been a few days into the new administration. This is going to have massive impact over different industries, particularly because the federal government is a large consumer of goods and services, and it drives innovation in certain areas through regulation. And if those layers of, for lack of a better way or a more elegant way of saying it, red tape, are sliced away, we may see some significant changes as a result of that. So we're watching this real carefully as well. The existing order that we remember for the past many, many years, I believe NATO was founded in 1949, April 4th of 1949, if I'm not mistaken. But that is under some significant stress right now. There's a lot of talk going back and forth that suggests that this alliance might not be as stable or relevant as it used to be. It remains to be seen what happens there, but the fact that there has been open talk about us potentially leaving that alliance or at least letting it fall away in importance leads to a whole different idea of the geopolitical landscape. Old norms that we all are accustomed to for generations are being rewritten at the moment. So that's going to change, international relations. And apologies, eventually I'll get it. So in a program that I'm working on with my education right now, we're talking about this thing called strategic bifurcation, which is a fancy way of saying the world is being divided into two spheres. There are, the established free world as it used to be during the Cold War, us, our allies, and so forth, who value intellectual property rights. And then there's another area of the world that's represented by some of our ideological opponents, let's say, who believe that intellectual property is the property of everyone and they should just be able to take it and innovate based off of it on their own. And they're taking it, a phrase I like to use is by fair means or foul. And, we're seeing some interesting things happen with these. There's a literal alliance happening between some of these ideological foes and us and our allies. And that has brought us all back to the us versus them mentality that I remember growing up with in the late 70s and early 80s. Yeah, you've got direct, great power competition. And that's an inflationary force. And I'm going to talk more about inflation later in this presentation, but, what was driving rates so low for generations, about 40 years, where rates did nothing but go trickle down, was globalization and cooperation on the international stage. And that is gone. And it's gone for the foreseeable future. So if we're insourcing and inshoring chip production, for instance, or other strategic assets, that's inflationary. We're not necessarily the best at making chips. They do that really well in Taiwan. They do that really well in China. It's much more expensive to do that here in the States, so prices go up. And everybody doesn't get to benefit from the division of labor at the global stage when things are like this. So that's going to be a force that needs to be reckoned with. And the good news is the markets have already adjusted to higher inflation and higher rates and seem to be doing just fine. Jumping into GDP. And this is going to be a little bit tough to see, but this is GDP going all the way back to the late 40s. And you can see it's pretty volatile. It spikes up and down, but the latest reading of GDP was 3.1%. And for a sustainable growth rate in the developed world, in a country like the United States, in economics class, the professor said, well, 2% is the long-term sustainable growth rate of a nation such as ours, a developed nation. We're growing much more like a developing nation right now. That's not a sign of economic weakness, not even remotely. Yet the Federal Reserve has been cutting interest rates. Not necessarily great. They want to be cutting rates when things are too, bad, not when they're too good. That's an inflationary force, and it bears watching. Is GDP going to continue to stay above that red baseline, which is below, if you can see it, which is actually 2%? The employment situation is another of the Fed's mandates. So the Fed has two mandates. One is, economic growth, and the other is the labor market and making sure that it's healthy. Well, the latest jobs reading was 256,000 jobs created in December, on the non-farm payrolls report that we got at the beginning of the month. That is not consistent with a weak economy. That's not consistent with the need for the Federal Reserve to be cutting interest rates, yet they've been. So again, it remains to be seen, but a lot of this stuff adds up to the point that's behind my talk here, and that is inflation is here to stay based on all of the data that we're looking at. Consumer sentiment. So consumers and consumer spending makes up about 2/3 of our gross domestic product. And consumer spending is obviously going to be driven by the sentiment, how we feel about the security of our jobs, the prospects for the economy and our companies and so forth. Are we likely to get a raise next year? Those type of thoughts go into your head when you think about this number. And that's still sitting at 71, which is not great. It's not at the high end of that range, but it's not at the low end either. It's not painting a negative picture where it is. Durable goods orders, same thing. So durable goods is anything that's expected to last more than 3 years. For most individuals, that's things like furniture or appliances. For companies, it's plant, property, and equipment. You're going to invest in a new plant. Well, you only are buying these types of things, particularly if you're doing it on credit, when you feel great about the economy, or at least you feel good about the economy going forward and what your situation's likely to be. And it's only declining by a relatively modest amount. Again, we're in the middle of that range. So things are not looking necessarily bad from a demand standpoint there either. Mortgage rates. Now, we hear a lot about this one, and everybody's a little uptight because, hey, rates are near 7%. I don't know what they are as of today. So 7 1/8 today. Well, I remember growing up, my dad was an educator, and we had the friendly rate because of that, and it was about 12 3/4 or something like that. So, yeah, 7% seems high only because we've anchored it to recent history where rates were down near zero. However, 7% is like pretty average according to history. So it's not bad there. We're still seeing real estate transactions. Some markets are experiencing a slight decline in real estate asset prices, but not a major one. And we think that the real estate market is still fairly healthy, even with rates higher. These things have been adjusted to. So, pardon me? Let's hear the question. Okay, this is a great question. I'm going to distill the information out of it to repeat the question for those who didn't hear that maybe. But, essentially there's been a great appreciation in prices locally. And in the context of higher rates and particularly rising insurance costs, which that's a whole nother animal, is that presenting a danger to current owners in this real estate market? And I would say probably not. And the reason is, consider that there are folks coming in here from much higher tax jurisdictions where property values are much more inflated. And so they've sold a co-op in New York for however much they sold it for and can come down here and buy cash. The mortgage rate is not impacting those folks, and this is an ideal area for those folks to come. So that's a large majority of transactions are happening here without ever touching the mortgage market at all. And that demand is likely to continue. If you're in a high tax jurisdiction and you can come to a place like Mount Dora in Florida where there's no state income tax, and you can get a much higher standard of living and a much larger property than you're accustomed to living in a big city, that's still an attractive transaction. And I don't see that changing for the foreseeable future. So hopefully that's a good answer. All right. So this slide here is rents, and it's important because, this is something that's somewhat linear. Rents are obviously just going to go up. They're subject to inflation. If you take rents as a percentage of what it would take to buy a house, it's actually quite low, and, by historical standards anyway. So if that potentially presents a problem in other markets, not markets such as ours, but in these bigger cities, this is going to be an issue, and we think that there is going to be a pullback in some markets for real estate. It's just not likely here because of the local dynamics. The Fed funds rate. So here's a fun one. We've taken the Fed funds rate all the way back into the late 40s again. Actually, I'm sorry, 1953 this one goes back to. And it tracks up all the way up to almost 20% back in 1981. Can you believe that? The overnight lending rate was like 21%. Yeah, it's crazy. And now those red bars that are going up and down on this chart represent recessions. And I would like to point out that we're at the tail end where it's just hooked down because they've done a rate cutting cycle. And you don't tend to see the recession until after the cutting cycle is done. So we're not out of the woods. There might still be a recession. That's why I had you knocking over there. But the reality is we don't know. Everything looks great now. We might see a recession. We might not. If the Fed has actually engineered that quote-unquote soft landing, it would be the second time since the 1960s, and only the second time. So the odds were not tremendously in favor of us avoiding it. I'm in the camp that thinks it really looks like we have avoided it for now, provided that they don't let inflation get back out of control, which is going to be a segue into the next slide. Maybe, assuming I can figure out how to, there we go. So I showed this last year and said, hey, Fed Chairman Powell is scratching his head trying to figure out what we need to do. And guess what? Still over at the Fed, they're scratching their head trying to figure out what to do. It's not changed. And in fact, that's a terrible, I wouldn't want that job because you're going to be in trouble for whatever you do or you don't do. However, it's really unclear what's the right move here. You have, is that a question or no? We have inflation moving up. And that's a signal for the Fed to put the brakes on this cutting cycle at a minimum and perhaps even say, hey, we messed up. We need to actually start hiking rates again because inflation's flared back up and we don't want that to get out of control. I'm of the camp that thinks they never should have cut this far in the first place. There was no real reason for it according to the economic data. But they're going to get pressure from Washington to continue cutting rates, and we might see higher rates of inflation, and that's what causes the recession. When inflation expectations go up, investment goes down, whether it's individual investment because the price of stocks starts to come down, or whether it's corporate investment because the cost of money gets too high. So we're going to be watching what they do. My guess is if I had to forecast, and you all in this room know I don't like to forecast. I prefer to set us up for whatever might happen in an optimized way so that it's okay regardless of what happens. But if I did have to forecast, I would say they're likely to have to, at a minimum, stop cutting rates, regardless of whatever they've been saying. Yeah, my apologies. It's not my clicker. Here's the Treasury curve, and this one's caught people off guard. So the Treasury bond is considered to be the risk-free asset. The only risk that an investor in a Treasury takes is that the value of their dollar is going to be different tomorrow and less than it is today because of inflation. Said another way, the $1 will buy you less tomorrow because of that inflation that you're experiencing today. So why did rates go up over 5-year horizon by 0.5 point or 0.75 of a point over 30 years when the Fed's been lowering rates? And that's the disconnect because, yes, when rates go down at the low end, it does not affect the whole curve. Those are longer-term outlooks that expressly bake in that inflation expectations, and the market is telling us, and when I say the market, I mean big institutional investors that drive the bond markets, sovereign nations, so the governments, the pension funds, large corporations that are using those as funding markets believe the cost of money is going up over time to compensate for their inflation risk. So that's all they're willing to pay for it. And so we have to be cognizant of what happens across the whole yield curve. It's not just, hey, the Fed just lowered rates, therefore all rates are going down. Eventually, I'll get this. There we go. Corporate bonds have done a similar move, and this is great for y'all. We're buying corporate bonds in your portfolios, and this is income. So cash flow, I remember, I don't know, someone tell me what yields were 4 years ago, probably like less than 1%, even on 5-10-year paper, and now you're getting 5% and a half even out on the longer run. Yeah, I mean, it's great if you're a fixed income investor, and you're not just a fixed income investor because you want to live on those income payments from the bonds. You're doing that as well. You're buying bonds because it reduces overall portfolio risk from owning stocks. Stocks like to go up and down and up and down, and it's a turbulent ride. But when you have the bonds, that smooths it out. Thinking it's taken about an average of 6 clicks. There we go. So consumer inflation, they're talking about how the Federal Reserve is targeting a 2% inflation rate, but yet inflation is persistently higher. The latest reading, which was, as of the end of last month, 2.9% in the consumer price index. Yeah, that's high. That's much higher than the 2% they're telling us. And we had a dynamic that was really interesting going on through 2022 and 2023 that's no longer present, and it does kind of put some doubt as to whether we're going to dodge that recession into play. And that is, this is the consumer inflation. Consumer prices can be looked at as a proxy for corporate profit. In other words, if I'm a corporation and I'm raising my prices to consumers by, let's call it 3%, as long as my costs are not up there as well, I'm actually increasing my margins and making more money, able to pay bigger dividends, and therefore justifying higher stock prices. However, that was one. Pretty good. Producer inflation went up by 2.8. So the dynamic was a couple of years ago and last year, producer inflation was near zero, and consumer inflation was up in the threes. So corporate markets were able to expand their profit margins, and that means more money for investors. That is no longer the case, and what that means for us is our style, which is, again, to bring it back to the beginning of this talk, based on fundamentals. We're looking at individual companies who's got what it takes to compete successfully, because that's going to matter now. It's not a rising tide lifts all ships kind of market anymore. It's, hey, you got to compete. You got to win. You got to have good financial structure in the company. You've got to have good strategy. You've got to have good marketing. All of these things that, myself and my team and other analysts are looking at and marking corporates for, that's what we want to be paying attention to. And there are going to be clear winners and losers in this type of environment. It's not going to be an indexer's market for the foreseeable future. Market volatility. So this is the VIX index. That stands for volatility index. Catchy, I know. It's low. 17.93 is as of when I printed this. But as of today, Travis, what was it? Oh, it dropped. Yesterday it popped up to 20 in a slight panic because of this thing that happened in China with the new AI, which I don't think is, again, as consequential as the news made it out to be. But the reality is this thing can spike out of nowhere. Look at this. It's down low. All of a sudden, wham, it's way up. So it's not time to be complacent. Market volatility could return at any point in time. In any case, the S&P 500 was up a little north of 22% last year, following on being up 20% the year before. And that begs the question of, oh, wow, should we pull back? Maybe that's enough and it's time to lighten the load. We don't know. Nobody knows. The thing to do is to adhere to a long-term plan. And if you look at the market over recent years, yes, there's been a long-term bull market for the past couple of years now, since the bottom of 2022. It was in October. However, sure, there's pullbacks here and there. Those are scary. But when you look at the longer term over, say, 20, 30 years, the pattern is clear. We want to be long-term investors. We want to stay on board, and we don't want to be reactionary. We don't want to make changes to well-thought-out long-term investment plans based on whatever is going on in the short term. Now, if fundamental conditions change, then your investment strategy takes a little bit of a tilt. But unless that happens, you stay the course, and you trust that it's likely going to work out, and you're positioned in an optimal way. So that's what we do at the bank.